I've actually had a drawdown recently, and it's another good question. I think you have to really learn. First of all, I like to identify why it happened. Often it's after my biggest winning streak. So I did have a good winning streak, and then I got hit. And I know I'm going to get hit when I do well after eventually, and it seems to happen. It gets you anyway a lot of times. There's almost this subtle subconscious relaxing in taking marginal trades or letting something run a little bit against you. Just leaks start happening when you're doing well because you're not as careful. And I think that's always a challenge for all of us. So when the drawdowns start, I'm always thinking about that. I haven't actually just taken time off just because I've done well, but it might not be the worst idea sometimes just to get away and clear the euphoria or the excitement just out of your system and get yourself reset if you can do that. Because when you're trading well, it feels great. You can't wait to come in and look at your screen and this is fun, but that's a dangerous place sometimes too. So when I'm really struggling, I like to just get out a piece of paper sometimes and do a throwaway trading journal where I write down, okay, this is what I think today. This is what I see. If these things happen, I'm going to do this. And then I just see what happens. And I try to obey that sheet and I throw it away at the end of the day and I start over the next day. And it just is a little discipline tool to kind of get me on track. And a lot of times what happens is, for me, is when I start drawing down, I notice that this is one of my coaching revelations, is I'll start to try to work hard to make up for it. So if I make a bad trade, I want to stay up late and work really hard. I want to read articles. I want to go over my mistakes. And I want to do all this activity to fix it. Right now, I want to fix it. I want to make it better. And if I work really hard, it'll mean that I'm going to make my money back. And it doesn't work that way. It actually causes more of a drawdown, because just because I work hard doesn't mean there's opportunity the next day or the day after. So a lot of times it's just laying by my dish, sitting out, passively watching the market. I call it an active pause, which basically means that I'm active and I'm ready to trade, but I'm planning to not do anything. And those are where my best trades come from. So I try to get into that state as soon as I can when I'm struggling. And also recognize sometimes if I'm struggling because somebody I talk to is doing well, they give me an idea, I decide I want to do the trade, it doesn't work out, and then I'm getting outside of myself now, and that can short circuit me. So I need to recognize that that's why it happened, take a break, and then kind of go back to maybe the journal or just the active pause where, okay, let's just hang out for a while and see what happens. That's usually a good place to be.
The switch from not being profitable to be profitable is just to follow the rules. Which rules? Psychology rules, any rules that you create for a strategy. It's just actually that simple. But the most important thing I would say is control and discipline. If you do have control and discipline with yourself, then you can control your psychology. You need to sleep well, you need to do all the things that actually they control yourself and be rational. So to be able to do that control, maybe you have to do martial arts. You need to do any other activities that give you control and discipline to be able to do what you have to do. So if you're not able to have control and discipline in your own house and life, I do believe it's very difficult to have control and discipline in your trading. It's more difficult, it takes you longer. If you're not able to control yourself as a person, you will be difficult to control yourself as a trader. And that is one of the main things, like a control discipline. I would say the main principle would say control, discipline, and follow the rules. I would keep it with these 3 points, yes.
So if I'm trading a 5-minute chart, which is what I usually do, and I see a bull channel, and all of a sudden there's an exceptionally big bull bar, and it reaches that top of the bull channel, I'm always going to be exiting at least half of my position, if not my entire position, depending on what else is going on. So one thing to do is exit during exceptional strength at resistance, especially if the top of the bull channel, if you look to the left on your chart and you see that it's also forming a double top, a top is testing a prior high. So is it both testing the top of a channel and testing a prior high? That would make me much more likely to get out of the market. And then the other thing is if the market goes down, and how far down? Well, it depends on your time frame and your goals as a trader. You know, if you're a very short-term trader, for example, if I'm trading the 5-minute chart and we have a bull bar and I buy the close of the bar or buy on a stop above the high of the bar, and we get a second bull bar, a third, and a fourth, and a fifth, and a sixth consecutive bull bar, at that point I'll have a pretty good profit. I will get out maybe the height of a bar below the prior bar. So let's say the bar is 5 points tall, and then the next bar is another bull bar, and then another bull bar. I'll get out with a stop about the height of a bar, 5 points below any bull bar. Also, if there's a bear bar closing below its midpoint, I'll get out 1 tick below the bear bar. And you can say, well, Al, it's stupid. If it's still forming higher lows and higher highs, it's still a bull trend. Why not put a stop below the most recent higher low? And I'll do that as well sometimes. But if I'm trading, I often will get out with a very tight stop, for example, below a bear bar closing near its low. And I'll do that because I feel confident if the bar after that is another bull bar closing near its high, I'll get back in. And most people can't do that. Most people, they get out and they say, whew, and boy, I need time to recover, and they don't get back in. But if you're able to get back in, then you can get out with tight stops, and you can just get out and get in, get out and get in, if the bull trend continues up.
Some simple rules for traders, whether you're discretionary or systematic, have different flavors of it, but the concept is what matters. So if you get to pretty much leave it alone until you get to X percentage of your max allowed drawdown. So typically I give it up to half of my max drawdown and just let it trade. So I don't do anything as I'm losing capital, but that can be a big number, so you got to be careful. But once I go over the 50% threshold, then I reduce by say 25%. And I've had different variations for different portfolios, so this is just a hypothetical example. Reduced by 25%. If I get to 75% of the way towards my max allowed drawdown, drop it down even further. So you can do it at different thresholds as you go down, and then as you come back up, you just reverse it. So once you're no longer within 75% of your max allowed drawdown, increase your allocation by another 25%. So, and then once you get within half of your max allowed drawdown, add another 25 to 50%.
An emotionally stable trader is not being affected by what other people do, right? They just continue on their path. Then what happens, of course, his trade went really well and would have been a massively big profit. That caused my trader to feel frustrated and to feel angry. And as a result of these angry and frustrated feelings, the trader started to go on tilt. So he started executing trades without following his strategy. And of course, he ended up in a massive drawdown. It was like a $10,000 drawdown. So that is a sign of emotional instability. Now, at the time before we spoke, all he saw was the drawdown. He was really upset, of course. And we then worked together and looked at what the trigger was. So the trigger was really that he was frustrated that he listened to someone else and didn't trust himself. And that then triggered the course of events. And what the trigger was, why that ended up in frustration, was because he had the feeling of not being in control. And what happens is when we feel we are not in control, we try to gain control back. And how do we do that? We do that by pressing that mouse button, executing trades. That gives us the illusion of control, but not really control, we know that. So that's an example of emotional instability. The work that we did was him being really clear on what the trigger is. And now he knows next time if he comes in a similar situation that he would be prone to making those mistakes. Now, that also leads us to high conscientiousness, Etienne, because in order to be emotionally stable, we need to look at high conscientiousness. A trader who is emotionally stable, they do what they say they will. They don't just do what they feel like doing. And this is a real big drawback that I see with traders who are failing. They do what they feel like doing. That means they say they're getting out of a trade at a certain level, then it feels uncomfortable, it hurts, and then they don't execute their loss. So they give in to that feeling of not wanting to feel bad by taking that loss.
Well, I think, trading is the evolution game. And I think, at the end of the day, it's about having a good strategy, having good mentors, and really trying to get a grasp of understanding it. Because while technicals are interesting and they're certainly valid, I think that, what you've come to realize is that you can't just rely on technicals alone.
The thing with trading is that it's not just what's out there, it's just not the system or the markets, it's you. Yeah.
Pete used to have a comment. He used to say, market understanding multiplied by you, that's your personality, equals success. And I couldn't agree with it more. So many people tend to have this idea, for example, all I need is a mechanical system and I'm going to make my capital return, and they forget the you element. And you can't do that, because you will always sabotage yourself if your methodology and your rules of risk management and your money management rules do not accommodate the way you feel